All right, we now have the latest unemployment numbers and the jobs report for the month of May, and it's giving some mixed signals, but we can start to see here that the unemployment rate is ticking up, and I want to talk about what all of that means going forward, as well as what we can expect out of the Federal Reserve in just a matter of days here, as we've got a lot going on, and this is a very, very important report here. This is a report that we get out once per month, and it was just released earlier today. I want to break down all the details for you right here in this video. All right, so this is a very important report, and in fact, you've heard me say this before in other videos. In my honest opinion, one of the most important economic data reports that we get every single month is this one, the Nonfarm payroll report, and it was just released today, okay? Now, let me break down the details for you. So, they were anticipating, as in analyst expectations were coming in, suggesting 193,000 jobs to be created. However, the number came in significantly higher. 272,000 jobs were created in the month of May, according to these numbers. However, over the last couple months here, revisions did come in, negative 15,000 for the previous month. So again, it's not that big of a deal to see that revisions came in. That's not that much, a 15,000 reduction. But remember, the report that we got out about a month ago came in at 175,000. So a lot of people were saying, uh-oh, the economy's cooling. Here we go. We're starting to see it in the jobs reports. Well, this report that we got out today, what is that? 80,000 more jobs than what they were expecting? Yeah, sorry, economy is not cooling at the pace that they thought, and this is going to completely disrupt the plans for the Fed next week as well. And again, more on that in just a second, but here are some other numbers. Here's a very important one, 4%. This is now the unemployment rate, okay? We have not hit 4% unemployment since about March of 2022. So it's been a long time. What is that? Little over 2 years was the last time. Yeah, few months over 2 years was the last time that we saw unemployment at 4%. Okay. Now we're seeing unemployment ticking up, okay? But does this simply mean that a lot of people are losing jobs and things like this? Well, clearly from the job creation, we can see that no. However, here's the problem as well. A lot of people in these figures, as in millions of people that are out there, are actually not even being counted in these figures because they've stopped looking for work, or they've been looking for work for so long that they're no longer calculated into these numbers, okay? So my point is, this is very important to continue watching because it's showing us the health of the economy, and it's also going to predicate the actions out of the Federal Reserve in just a couple days here, okay? Now, another point that I want to point out for you really quickly, okay? It's showing that wages, as in incomes that people are receiving, are still strong, going up yet again on a month-over-month basis. So it's still showing that as wages continue to rise, what does that show? More purchasing power for people. Does that mean that inflation is going to come down anytime soon? No, okay? It's not that hard to figure out. If we, the consumer, have money and we're spending that money, does that mean that inflation is going to go down? No, it doesn't work that way, right? When disposable income, when money is available, we spend it, we buy goods and services, we buy junk we don't need, and that continues to keep prices high, okay? It's not that hard to figure out the equation here. But anyway, here's something else that's very interesting about this. The labor participation rate. Now, I find this to be a very fascinating number because the labor participation rate gives us a percentage of people that are ages between 16 and 65 that are working, okay? Now, this is interesting. It came in at 62.5%. In other words, 62.5% of the people out there between the ages of 16 and 65 are working, and the other 37.5% of the population is not, okay? Now, this is interesting because last month, this labor participation rate number came in at 62.7. So it went down by 0.2% just on a month-over-month basis. Now, again, it's showing less and less people are working. Does that paint the whole picture? No, but it does give us a glimpse into what's really going on across the country, right? All right, so with all that being said, okay, so here's the little bit of a mixed signal that we're getting here, okay? So we were expecting 193,000 jobs to be created. We got 272,000 according to this report. And again, fill in the blank with whatever you believe, but Is this really accurate or not? Who knows? We'll see what happens here over the coming months if we get revisions or not. But my point is, okay, so we got 80,000 more jobs than we were expecting. Unemployment went up from 3.9% last month to 4% now, okay? So we went up 0.1% on the unemployment figure, okay? But that doesn't paint the whole picture. Now, let's look at next week here when the Federal Reserve meets for their 2-day FOMC meeting, and on Wednesday when we do get that announcement out of the Fed on their decisions on interest rates. Do we think they're going to cut? No, not a chance. Don't plan on it. They're not cutting. They're 100% pausing unless they maybe even jack up rates even more. I wouldn't be shocked to see that, but I would anticipate they pause yet again, okay? So there's a lot of people out there saying, oh, they're going to cut this time. No, they're not. Are you kidding me? There's not a chance in HE double hockey sticks that they are going to be cutting this month. Not a chance. Don't plan on it. The Fed is not cutting anything, okay? The only thing they're cutting is cheese, okay? I just thought of that. Anyway, they're not going to be cutting interest rates anytime soon. Absolutely not next week, and probably not in July either. But my point is here, okay? Now, when they continue to keep interest rates very high and elevated like they have for the last, several meetings here, I think this is going to be meeting maybe number 10 or so, maybe 9 or 10, that they've been holding rates steady, okay? When interest rates stay high, elevated like this for a prolonged period of time, it just continues to contract on the economy more and more and more. The analogy that I've used in other videos is think of like a boa constrictor, right? A big old snake. How does it get its prey? It wraps around it and it constricts, right? It wraps around and it tightens up more and more and more and more. The longer that prey is tightened by the snake, right? The more that it doesn't have a good chance. You get what I'm saying, right? It's not a good situation for the prey. Well, the same situation here. The Federal Reserve is like the boa constrictor and the economy is like the prey. Federal Reserve has wrapped around the economy, and every single month, every single meeting that it keeps these rates very high and elevated, it's contracting a little more and a little more and a little more, making it a little bit more difficult for that prey. In this case, it just so happens to be the economy, right? So my point is, these high interest rates are slamming everybody. Everybody's feeling this. I'm not sure about you, but I'm feeling it. If you're floating a balance on a credit card and your credit card interest rates are sitting at 21.5%, 22%, something like this, you're feeling it. I'm not sure about you. I'm feeling it and I'm frustrated, okay? You're probably seeing that lately. It's annoying with these interest rates. Not only that, if you're trying to borrow money for a car or a house, or, like I said, floating a balance on a credit card, or personal loans, or lines of credit, or if you have an adjustable rate mortgage, anything like this, all of these things are going up. Anything that has an adjustable interest rate, these rates are staying high. With interest rates staying high like this, it's more money that's being siphoned out of our bank accounts, out of our paychecks, out of our fixed income benefit checks, whatever it happens to be. The higher that these interest rates are, it just means more money going out of our pocket and into the accounts of banks and financial institutions and things like this that we owe these debts on, okay? Not only that, businesses, small, medium, and large, are not borrowing. They're not doing anything. Therefore, this is going to stall out the economy. I know I've been saying this for a very long time. I get it. I totally understand this as much as you do. I've been saying this for a long time. The economy's stalling. The economy's contracting. The economy's slowing down. All this stuff like this. I know this. I've been saying it. But here's the thing. The longer that this goes on, the bigger and bigger that the economic drop, the bigger the plunge, the bigger the contraction, the bigger the collapse is going to be when that sucker finally comes around, okay? It will happen. At some point, it's going to happen. This cannot go on for very long. It's already been going on for a couple years, well over a couple years now, where these interest rates have been continuously going up and staying high and elevated. This is hitting a lot of people and businesses hard, and this is all going to come home to roost at some point. We cannot go on like this unimpeded and be like, oh, all's good, the economy's fine and healthy. For now it is, okay, but it's going to happen fast. When we get whacked, we're going to get whacked good, okay, and it's going to be an ugly picture, and you're going to see a bunch of people scrambling, the Fed included, cutting rates aggressively someday at some point, but in June, it's not going to be the case. In July, likely not going to be the case. Maybe September, who knows? We'll see. They'll probably time it right before November, very nicely timed. It won't be for any good reason other than the fact that, political reasons is why. Anyway, long story short here, the unemployment rate just came out, 4%. We're moving up, and that's good or bad, depending on how you look at it, but the higher the interest rate, the higher the unemployment rate goes. Okay, I'm going to say this really quickly. The higher the unemployment rate goes, the higher likelihood of a major economic crash, major economic contraction, and the higher that the unemployment rate goes as well, in my honest opinion, the higher it goes, the higher likelihood of stimulus checks when the economy crashes and burns. Okay, right now, no stimulus checks. I say that all the time. But if this unemployment rate continues to go up, if we scratch at another point of this, if we're up at 5%, 5.5%, 6% in unemployment, it's going to get ugly fast. Okay, my point is we're not that far away and we're ticking up here. So I'm gonna leave it at that for now. If you want me to come back and elaborate on this, I can jump on a live stream. Let me know what you need from me. I'm here for you in any way that I possibly can be. Enjoy your day. Take care. Have a good one, and catch you again later in the next video. Subscribe down below. Share the video. Check out the other videos here on the channel down below in the description or the top of the comment section in the video library right now popping up on your screen. Check out those videos. Thanks for your support. Subscribe. Share the video.